It has been a volatile stretch for global bond markets recently. In the U.S., the effect of a prolonged government shutdown has left its mark, with investors flying blind without federal data, while the Supreme Court questions the legality of tariffs. Meanwhile, in Canada, the latest federal budget has been described as long on ambition but short on near-term growth. So with so many cross-currents, how should investors make sense of what's happening in fixed income right now? Joining me now is Alex Gorewicz, Portfolio Manager, Active Fixed Income at TD Asset Management, to explain everything. That's a tall order.
What does, yes.
Go. No, just explain it all.
Don't do that, Kim. Nice to see you.
Well, where do you, it's always lovely to see you. Where do you want to start? Like when you think about, you know, the picture that that we painted in courtesy of some of the things that you've been telling us of what you're watching, what are some of the more material things you're watching right now, and then we can dive into them?
I think at a high level, it's the totality of the data. I know some data is missing, but we still have a lot of information that we can process and that we are processing, whether it's government data at state levels, whether it's alternative private sector data, whether it's Federal Reserve data. The Federal Reserve is independent of the government, and they are continuing to publish survey data and other good quality data for us to process. And when we look at the totality of that data, what it's telling us is that growth is chugging along, but it's neither very strong nor very weak. So from a bond market perspective, there are a lot of additional things that investors are paying attention to, namely earnings season, and looking at, we'll call it beats and misses of various sectors or stocks.
Let me ask, so we'll focus on the U.S. market first, then we'll get to Canada second, but let's go on the corporate side a bit, so whether it's corporate bonds or just the corporate data that you're getting to understand what's going on. And I should mention, there's a lot of supply of corporate bonds coming out right now, and I think a lot of demand actually sucking all that supply up. But what are you seeing from the earnings and the misses, and what is that telling you?
I think the earnings and the misses aren't real misses. I think they're misses relative to expectations that earnings will beat 20, 30% relative to expectations. Those super beats aren't happening. We'll call it with the same frequency as they were a quarter or two ago. And I think it's causing some investors to take stock of the picture. And then in addition to that, that debt issuance you're talking about, and let's say specifically on AI-related debt issuance, that wasn't a factor a quarter or two ago, and now it is. And the moment debt joins the party, there are growing concerns that, maybe this is very late stage.
Yeah. Tell me more about that, just that late stage piece. Like why, tell me like I'm 6 years old. Why does that matter? How does that change the picture?
Because some investors feel that in order to maintain the same level of growth prospects, you now need to fund it with debt, and that's absolutely not the case. I mean, if you look at some of these very large, like AI, that's right, and they have so much cash on their balance sheet, but there's also so much demand for these bonds, like you're talking about. You mentioned, there's a lot of supply, but a lot of demand that meets it. So, for example, I won't mention specific stocks, but the likes of like a Google or a Meta, they've come to market, and demand, for let's say a $10 or $15 billion issue has been closer to $100 billion. So it just gives you a sense of the magnitude of how much investors are actually excited about these investment opportunities, even if from sort of a broader AI theme perspective, it feels a little frothy.
Interesting. It's kind of like, is it the good or the bad? You're kind of just waiting to see. I guess it depends.
Correct.
Your longer term and what you think is going to happen. I need to ask you though as well about. I mentioned the Fed. I mentioned of course, there's going to be somebody new coming in at some point. Also, the legality of the tariffs, and that has a huge impact on government bonds as well, too.
Yes. So a couple of things on that. When we think about the tariffs and the Supreme Court ruling, we won't really know which way they're going to rule. They have to consider all of the arguments that they've heard. It could take, I don't know, a month, 2 months. So expect that to be some point December or January after the next Fed meeting. But I think from a bond market perspective, investors are looking at the situation and saying, if the Supreme Court says the U.S. administration isn't allowed to use IEEPA or the emergency powers to enact tariffs, well, there is $30 billion a month of revenue from these tariffs that the government doesn't have access to anymore. how will that be funded? Right? Will that mean that the bond market is going to be faced with a lot more treasury bond supply? What we have noticed is the long end of the yield curve, so thinking about 30-year bonds and longer, those are very sensitive to supply dynamics. So any whiff of additional bond supply will very likely see those longer-term interest rates rise. When it comes to the Fed, this idea of a new Fed chair, the Fed's credibility or independence being compromised because, President Trump will put somebody that sees eye to eye with them on monetary policy. None of this is really reflected in the bond market at the moment. Corporate spreads are very tight. Government bond yields are actually lower year to date across the entire yield curve. Inflation expectations are very anchored, even shorter term, longer term. What we would be worried about if bond investors start to get worried that the Fed's actions are not really in line with economic developments would be if longer term inflation expectations start to rise. And again, here you see this reinforcement of that pushing up long bond yields higher. So there are risks that the fall in long-term interest rates we've seen in the U.S. year to date, that could reverse in the coming quarters. I
want to squeeze a couple more questions in. I mean, we've had, and this is not in the public markets, in the private markets, we've heard about concerns about private credit and just some of those things. Is there any spillover that happens into the public markets from that?
I think I wouldn't characterize it as spillover. I would characterize it more like a confluence of factors that make investors question, we'll call it the health of the economic fundamentals relative to those tight corporate spreads, which exist.
That frothiness again, right?
That frothiness again. Yeah. In some cases, absolutely justified. High quality blue chip companies, even if they're coming to market and issuing more debt, they still have tons of cash, strong operating margins, no concerns there. But whether you're talking about private or public, the reality is interest rates are higher than where they were several years ago. Inflation is higher, that eats into margins. So costs are pressured. If revenues become pressured as well, for example, some public high yield issuers, they tend to cater to lower income consumers. Lower income consumers are finding it really, really challenging to deal with a high cost of living, right? Because even if year-on-year inflation isn't running away like it was back in 2022, price levels matter, and their wage growth is not keeping up with where prices are. So when you look at the totality of where some issuers, public or private, are operating, they are some of the weaker segments are absolutely struggling. And so in private markets in particular, you've had some wobbles, some either defaults or bankruptcies, and that has caused some angst in investors.
If we turn to Canada, we saw a big budget come out, generational, and depends on your perspective in terms of whether you believe that to be true, but that's what it was called. A couple questions. I'll ask you, what are the two most important things you're watching coming out of this budget, and what bond investors are going to be paying attention to?
The first one would be, the way I characterize the budget is not generational, short-term pain for long-term gain. Okay. Maybe not too much short-term pain, but what I mean by that is there are a lot of cost-cutting measures that should be felt relatively quickly, whether it's reducing the public labor force, whether it's cutting down on some programming costs. That could have an impact of reducing growth prospects in Canada in the near term.
Got it.
All the capital investments are long-term, and in particular, the idea of trying to attract, we'll call it manufacturing or industrial capital. To the extent you can do that, you should see that reflected in the first several quarters of next year, if not by the end of next year. If that doesn't happen, immediately the bond market will say, okay, so growth should be a lot weaker in Canada. The second thing that I am watching is that those cost-cutting measures, if they don't materialize, that's, we'll call it $60 billion that the government is trying to target, that will probably need to be funded with debt. And again, the bond market will look at it and go, lower growth prospects and higher debt, not a good combination.
Yeah. And the net on that will be what, when you kind of look out of the combination of the investors not believing, perhaps, the prognosis of what the federal government is saying?
I think what that would do is it would force Bank of Canada to probably take more action by cutting interest rates further, which would pressure shorter-term bond yields lower, but longer-term bond yields will very likely respond to higher debt supply longer term, and that would very likely push up bond yields at the long end of the yield curve, so we would get what we call a steepening of the yield curve.
What about, just going back to the first part you said there, and I've got about 90 seconds here, but when you think about, you said you want to see signs that investment is coming into Canada. What are those signs? What will you look for to say that, yes, we're attracting investment as we had hoped to?
Well, business investment first and foremost, which has flatlined. We actually want to see it. I think before we even want to see net positive business investment, we just don't want to see capital going down south anymore, flying down south, if you will. Capital will go where it's best treated, and at the moment it's best treated in the U.S., but hopefully some of the changes that have come through in this budget in Canada would keep some of that money here at home, but now we just need to see some positive dynamics as well. And I do believe that if the government doesn't see that, I do believe that they would take more steps this time next year in the next budget.
And something to incent. And the same thing I would say on the other side is in terms of crystallizing those savings to see that actually impacts a run rate.
Correct.
Yeah.
Correct. So a lot of unknowns, but I think they've given themselves enough flexibility to be able to respond accordingly.